Good afternoon, everyone, and thank you for joining us today for our quarterly market investment updates. This is a 1-hour session that we host every 3 months or so, and it's being hosted by Counselor Buchanan and Mitchell and MBI, the firm's wealth management subsidiary. And our presenters today are Debbie May and Alex Seleznev. Debbie is a partner at CBM, and she is co-founder and chief investment officer of MBI. She has 35 years of experience providing comprehensive financial planning and nearly 30 years of providing investment advisory services. Debbie is a certified public accountant, a certified financial planner professional, and a certified divorce financial analyst. She's been recognized 9 times by Washingtonian Magazine for her financial advisory expertise throughout the DC metro area, including most recently as a top money expert in January of 2021. Alex Seleznev is a partner and a director of wealth management and financial planning services at CBM, and he's also a co-founder of MBI. Alex is a certified financial planner and a chartered financial analyst who leads the firm's investment management division. His professional focus is on comprehensive financial planning and investment management. He is also a regular presenter for CBM and MBI, including during the firm's quarterly market updates, as is Debbie, and well-received sessions on Social Security, Medicare and Medicaid considerations, and strategies for choosing the right financial advisor for you. We'll be offering CPE for this session. Not everyone is necessarily here for CPE, and that's perfectly fine. What I'm going to do is I'm going to launch a sample poll right now. So it should be on your screen or in the chat box. And I'm going to keep each of these up. I'm going to launch 4 polls over the next hour. So if you are interested in CPE, please just click, "Are you still there?" and then hit the submit button. To get CPE, please submit 3 of the 4 polls. So I'll come on occasionally during the session just to launch the polls. For those of you who submitted questions during the registration process, thank you very much. Those have been sent to Debbie and Alex, and they've been woven into their presentation. But if at any time you have questions, please feel free to use the chat box, and they're monitoring that, so we'll be able to take questions throughout the session. This is being recorded. The session is being recorded, and we'll send a follow-up email with the slides, a link to the recording, and details about CPE. So I think that's about it. Now I think I'm reading the learning objective slide as well for CPE compliance purposes. So for those of you on the call, as a result of participation today, attendees will learn how market conditions are impacting investment performance and investor sentiment. You will learn about the impact of current events such as inflation, conflict in Eastern Europe, and other current events, how they're impacting investor buying and selling decisions. You will learn about short and long-term investment strategies in response to current events. And finally, you will learn financial planning ideas to consider in the future, including Roth IRAs, tax loss harvesting, withholdings, and others. So with that, I will turn it over to Alex and Debbie.
Thank you, Joe. Appreciate it.
Thank you, Joe.
And thanks everyone, of course, for joining us today. And what I usually do prior to this webinar is I look at the list of participants, and as usual, we have a lot of our existing clients, actually quite a few of our newer clients. So great to have you with us, and actually a lot of new names or perhaps part of CBM. So welcome. And for those of you who are less familiar with what we do, well, we're part of CBM. We focus on comprehensive financial planning work. Essentially, we develop financial plans for our clients that include cash flow management, insurance, education planning, retirement planning is, of course, a big piece of it, as well as estate planning. We do a lot of tax preparation and tax planning work. We're very much tax-oriented, and of course, investment advisory work, specifically discretionary investment management. In terms of working with us, we're a fee-only firm. I always like to say that we always serve as a fiduciary when we work with our clients, and we're not part of any broker-dealer. So every decision that we make is done by our team in-house. And in terms of our team, we have 8 people at this point. We have 4 advisors, and we also have 4 analysts at this point. And we actually just added the new analyst to our team, Josh Hunt. So great to have you in our team. So we're growing. Of course, if you have any questions, feel free to reach out to Debbie or myself, or feel free to visit our website on the bottom of this slide. And with that, let's get started. Usually in our quarterly market updates, in the very beginning, we try to add a little bit of humor. So hopefully at least some of you will find it at least a little, funny. So here's this two gentlemen here just chatting casually. And one of them is saying, I don't know about you, but if I win the lottery, I'm going to fill my gas tank. So perhaps, some of you felt that way, especially if you've been driving quite a bit, for summer vacations, and perhaps if you have a bigger car. There are other stories. I don't know how real they are necessarily, but one that really came to mind this morning, somewhere in Midwest, there was this person who decided to fill up his tank. Apparently it was, $150 or more to fill up his gas tank, and he just drove away. So he knew that there would be a penalty for doing that, but apparently it cost him less to make the penalty payment that you actually pay for his gas. I don't know if that's real or not, but you keep hearing stories like that. So with that, let's get started. In terms of the structure for our quarterly market update, again, for those of you who participated in the past, it's actually going to be similar. We'll talk about the markets, of course, update everyone on where we are at this point. Then perhaps a new piece here will be on behavioral finance, which we believe is important, especially in turbulent markets. We'll certainly share some of our top investment ideas, and then we'll finish with some financial planning ideas as well. So in terms of the market conditions, well, I'll start with essentially stating the obvious. We are in a bear market territory as we speak today. And in terms of the technical definition of that, perhaps for those of you who are less familiar, that's when one of the major indices, and usually they refer to the S&P 500 index, is down by 20% or more, and you remain in this, again, bear territory up until you reach that negative 10% or so. That's the technical definition of that. So as of last Friday, and hasn't changed all that much over the past 1.5 days. Domestic large cap stocks are down by 19%. More growth-oriented stocks that are usually represented by the NASDAQ index are down by close to 27 percentage points. Small caps are down by 22, which is not surprising. They tend to be more economically sensitive than large cap stocks. In terms of emerging and developed markets, both are down somewhere between 18 to 22% as a category. Of course, different countries perform quite differently at this point. One quick comment on developed markets specifically, post invasion, specifically by the end of March, many European stocks were down by as much as 30%, I believe even more actually for a short period of time. So European stocks actually recovered by quite a bit, but still in the negative. Domestic bonds, as measured by the Barclays Aggregate Bond Index, which is just like the S&P 500, but for bonds, are down by a little more than 10% for the year. They actually recovered a little bit since the end of the first quarter. At the end of the first quarter, they were down by 12% or so. Now, again, a quick side note here, that is the index itself. So shorter term bonds are down somewhere between 2 to 4% this year, so much more manageable, I would say. And longer term bonds, especially for certain categories, are down by more than 20. So again, that's another reminder that bonds, at least in the short run, can be quite volatile. In terms of the 10-year Treasury yield, something that we pay close attention to, that's the so-called markets interest rates. The Federal Reserve Bank or the Fed controls the short-term rates, but then the markets tend to control longer-term rates. Currently at 2.8%, we actually hit the 3% mark a couple of weeks ago at this point, and since then it came down a little bit. So if you compare it to where we were at the end of last year, well, interest rates actually doubled. The real rates actually doubled over the past 6.5 months or so. That has a pretty direct impact on stocks, specifically growth-oriented stocks, because they tend to have a lot of their revenues, projected to happen in the future. So when you discount them back to determine the value of those securities, usually, higher interest rate would result in a bigger discount rate. Same with bonds. There's this inverse relationship between interest rates and bond prices, at least in the short run. It's not always linear, but something to keep in mind. It's again why we pay attention to it. In terms of the sector performance, actually no particular updates here. Energy is the only sector that is in the positive this year by 24% as of last Friday. Again, for those of you who participated in our previous webinar, energy was up by more than 40% at the end of first quarter of this year, so actually it came down quite a bit. Utilities are now in the negative, and for the most part of the first part of the year, they were actually in the positive. And in terms of what's on the bottom, well, consumer discretionary and technology stocks, anywhere between 24 to 29%. Many, perhaps even most of those stocks are in the growth category. We'll talk about that separately. So in some sense, there are no surprises there. In terms of the market conditions and our market outlook, and this is, of course, a very brief summary of our thinking, we do expect to see more market volatility, specifically in the third quarter, perhaps throughout the summer, perhaps things will begin to settle down more closer to the end of the year. One of the interesting ideas here, if you kind of compare where we are at this point versus where we were in 2020 or even 2021, it's a very much data-driven market, not so much even sentiment-driven, not so much valuations-driven. Everyone is looking for that next piece of data, specifically when you look at an inflation and interest rates. Now, one of the things to point out, we focused on this in our previous webinar, but certainly this needs a follow-up in terms of the conflict in Eastern Europe. I'll just say directly, there's no clarity at this point, in terms of how long it will take. But in terms of the impacts, one way of thinking about it, if you can separate them in direct and indirect impacts, at least from the perspective of U.S.-based investor, U.S.-based company. So in terms of the direct impacts, I'm inclined to say that a lot has already been priced in. And what I mean by that, and I would rather not make any specific examples in our webinar today, but a lot of companies, of course, decided to exit that part of the world. They're shutting down already, essentially shut down their operations. And when they discuss that in their quarterly updates, in many cases, the impact is anywhere between 1 to 3% of their global operations. So of course, it's going to impact their earnings to the negative, but it's not likely to be as significant. In terms of the indirect impacts, chances are they will linger for quite some time, and I'm mostly referring to the impacts on inflation and specifically inputs for different things, specifically for manufacturing companies. Oil prices, I don't have to tell you much about oil prices, even though they're actually down by more than 20% since they peaked at 130 per barrel, if I'm not mistaken. Natural gas, something that many people don't necessarily pay that much attention to, but it more than tripled in price over the past 6 to maybe 8 months at this point. So that's heavily used in production. And of course, other types of commodities, including wheat and grain. That part of the world exports a lot of it. So in terms of the indirect impacts, they will likely linger. Now, again, inflation and interest rates, back to this data-driven markets, that's what everyone is paying attention to. When will the inflation, the CPI specifically, when will it peak, and exactly what the Federal Reserve Bank is going to do to essentially fight it. And we'll talk about that more in just a moment. In terms of the market sentiment, we're inclined to say that over the past, maybe not 3 to 4 months, but maybe 1 or 2, the sentiment became actually less bearish. In terms of the updates that we're hearing, different analyst expectations, different economic reports, they're still mostly in the negative side, but certainly not as bearish as they were at the end of the first quarter specifically. Valuations. This is something that is certainly of interest to us. We consider ourselves fundamental investors. So in terms of where we were at the end of the quarter, this is at the end of the quarter, the forward P/E ratio, price to earnings ratio for the S&P 500, essentially for the U.S. stock index, was at 15.8. And that is compared to essentially 21, which is where we were at the end of last year. So for those of you perhaps less familiar, simply put, the lower the better. You want it to be essentially as low as possible. That indicates that you're getting a good price on your purchase. If you compare it to the past 5 and 10 years, as you can see on the slide, we're actually below as well. Now, of course, maybe I'm being a little bit of a glass half full type of person, but when you look at the PE ratio, there are actually two important things here, right? There's the price, and it's factual. We know what the price is at any point in time. In terms of the earnings, well, as you can see here, these are forward earnings, and someone has to essentially predict what those earnings are going to be in the future, right? So that's important. That's another reason why we do pay attention to the earnings expectations. And as you can see on the slide, they're actually quite depressed for the second quarter of this year, and we just started the second quarter earnings season just started actually a week ago. The estimate is only 4.2%. And that is compared to 9.1. That's the actual for the first quarter. Now, for the entire year, the consensus estimate is still 9.9. And I'm inclined to say perhaps we need to put a little bit of a question mark behind that figure, especially if you consider inflation and potential for interest rates to go up. In terms of the economic conditions, well, say it's fair to assume that we're expecting the real growth, the real GDP growth to decline in the second part of the year, mostly impacted by inflation and interest rates. One quick side note here, one of the people we know actually made this comment, but the US economy is actually growing if you look at it from the nominal perspective, and it's actually growing quite nicely. In the first quarter, it increased by a little more than 5 percentage points. But when you adjust it for inflation, that's when it turns out to be in the negative. So that's just something to keep in mind. One of the questions that was submitted to us, well, what are your thoughts on the potential recession? Well, the best answer I can give you, there's probably a 50-50 chance of that happening this year. And again, what do you consider to be a recession? Technical definition behind that is when we have 2 consecutive quarters of negative real growth. Personally, based on what we've been seeing, and especially given that inflation is at 9.1%, there's a good possibility that the next number will be in the negative. So technically speaking, we will be in a recession. So here's an interesting scenario that we've been discussing, with some of our clients, and it just really makes you think. We refer to it as a catch-22 scenario. So at this point, very many people are aware of this, real possibility of, having a recession. If you look at it from a perspective of a corporate CEO or as a consumer in general, when you're expecting things to slow down, well, what is it that you do? You also slow down your own spending, your expansion plans. Perhaps you're spending less on labor, you're hiring less people, you're not stocking up that much of inventory. Well, if that's the case, then perhaps we'll see less pressure on the overall demand. If there's less pressure on the overall demand, perhaps there's going to be less pressure on inflation. If there's less pressure on inflation, perhaps the Federal Reserve Bank or the Fed is not going to be as aggressive as many people expect it to be in terms of their monetary policy, specifically raising rates and essentially unloading their $9 trillion balance sheet. So perhaps as a result of that, there's not going to be a severe recession, and we'll have what many people refer to as the soft landing scenario, when the economy slowed down just enough so that inflation begins to go down, but there's no severe impact. So in terms of the numbers, well, the latest figure for the US real GDP growth, the revised one, is only 1.7%. Inflation, something tells me majority of the participants are aware, is at 9.1%, which is the highest over the past 40 years. Now, in terms of the CPI measurement, it's always a lagging indicator. This is for the month of June, even though, again, the markets tend to be quite dynamic. And if you look at certain key commodity prices, specifically natural gas, oil, and copper. Those three actually down by almost 30% over the past 3 weeks or so. So perhaps there is going to be some impact on the CPI figures in July, not so much on other things such as corn, such as grains. So again, we'll wait and see exactly what's going to happen. Unemployment rates, again, in terms of the positives here, they remained at 3.6%, went up and down a little bit. And actually the latest jobs report 2 weeks ago, 374,000 or 372,000 net new jobs versus 250, which was the consensus estimate. So then the employment market or the labor market is quite robust. And that is, again, if you're trying to be more on the positive side, when someone is expecting some kind of severe recession, well, it's somewhat unlikely that with this kind of labor market, you're going to have that type of scenario. So something to keep in mind.
Excuse me, Alex, I'm just going to interject here real quick. I'm going to launch the first poll. It'll be on the screen or in the chat box. Please submit it if you're interested in CPE.
Great. And I actually needed a little sip of water. All right, so what you're looking at here, this is so-called asset class return quilt. Actually, one of my favorite slides to discuss. The data here is as of the end of last quarter. So just, I guess, for those of you who are less familiar, what we're showing you here is the performance, annual performance for each major asset class. And then on the right side, we summarize it for you. And then we also show you the year-to-date performance results. Now, today's webinar, I actually don't have that many comments. I mean, besides saying that pretty much every major asset class is down this year, besides commodities, they're still up by more than 14%. But again, they're up close to 40 at the end of the first quarter. So there's, again, quite a bit of volatility. And again, one of those concerns, and it's heavily discussed in financial media, so-called balanced portfolios. If you look at their performance over the past 10 years, including 2021, well, they're mostly in the positive. That's what creates that hedge essentially. That has not been the case. So perhaps this is, again, a good time. Not saying necessarily that you need to rebalance into something entirely different, but at least consider other options. In terms of the domestic stock performance for the year, and this is actually where we spend a lot of our time, especially when we rebalance our managed portfolios, and we almost finished that as part of our semi-annual rebalancing cycle. So on the right side, what you're looking at is the performance for all 9 asset classes in 2021. So you have your large, mid, and small cap stocks, on the horizontal line, and in the vertical lines, you have value, core, and growth stocks. And very briefly, growth is technology, consumer discretionary stocks. A lot of revenue is expected to happen in the future. On the value side, you have more mature companies that are not necessarily growing as much, but tend to generate dividends. And on the core side, essentially in between. Healthcare is a good example of that. A lot of mature companies, but they're still growing and tend to generate quite a bit of cash flow. Now, in terms of the year-to-date performance results, well, in some sense, the opposite of that, the opposite of 2021. But there's this interesting pattern that actually remains throughout most of the year, is that most of the decline for the U.S. stock market actually happened on the growth side. So at the end of the first quarter, it was roughly 3/4 of a decline. Now, if I'm just doing my simple math, perhaps it's 2/3. But again, the fact that interest rates went up and they're expected to go up even more, that was actually one of the questions that was submitted to us, well, mostly impacted the growth side of the equation. On the value side, what's interesting here, as of the end of May, it was actually in the positive. So a lot of the volatility on that side happened in the month of June. But from our perspective, again, we certainly see some opportunities there, and we'll talk about that separately. Now, in terms of domestic bonds, I mean, we already summarized where we are at this point. And when interest rates are going up or expected to go up, usually that's considered to be a negative thing from the perspective of equity or fixed income investors, at least in the short run. But there's certainly positives behind that. if you look at the yields of some of the, I don't want to call them risk-free, but low-risk investments, they're certainly much higher at this point versus where we were, 6, maybe 8 months ago at this point. High yield online bank accounts, it's actually at 1.3 as of today. When we updated the slides, it was at 1.2%. Certificates of deposit that mature in 6 months, so short-term CDs at 2.6%. Short-term government bonds, essentially those that mature in 1 to 3 years, 1.9. There was a question about the I-series government bonds. They yield 9.62%. And again, very briefly, for those of you who are less familiar, they adjust based on CPI, based on inflation. So the rate actually adjusts every 6 months. They're currently paying 9.6%. The issue with those is that you're only limited to $10,000 per person, and you have to hold those bonds on the website, essentially treasurydirect.gov. You can buy $5,000 more, but you would have to buy paper bonds, and you would have to use your federal tax refund to do that. So again, to address the question that was submitted to us, is this a good strategy? Well, yeah, I see nothing wrong with that strategy, but depending on the size of your portfolio, you would not necessarily be able to allocate that much to it. And then finally, in terms of the short-term investment grade bonds, again, those with maturities of less than 3 years, you're looking at 4.2%. Now, I was actually making some notes for our next webinar. What we're not discussing here is perhaps a little more, exotic choices, such as preferred stock, pays between 5 to 6% at this point. It's essentially a hybrid between stocks and bonds. High yield bonds, or below investment grade bonds, that's a different way of calling them, are yielding between 7 to 8% at this point, and that is versus 3 to 4 at the end of last year. So certainly many more options for you to choose from depending on your preferences. So switching gears here a little bit. So behavioral finance, what is it and why should you care? And again, in terms of the timing, we thought it would be a good idea to discuss it specifically when the markets are turbulent. So, there are two directions, right? There's this traditional finance, when you focus on fundamental investing, different ratios, a variety of different numbers, essentially. And then there's behavioral finance, which is essentially the study of the effects of psychology on investors and their financial decisions. The way we see it, in terms of how we structure our meetings or even how we discuss this internally, we do believe that behavioral finance is an integral part of the overall investment process. And one thing I want to make very clear, it impacts both retail and professional investors. That's very important. So it really impacts everyone. And essentially the end goal here is to explain, irrational behaviors, even when people actually have access to, data, but they still essentially disregard that data and behave irrationally. And perhaps a classic example of that is this whole concept of buying low and selling high, right? And if this was one of our in-person, not webinars, but meetings, I guess I'll say, our seminars, I would ask that you, raise your hand if you're familiar with the concept. And chances are pretty much everyone would raise his or her hand. But then when you look at it in practice, how many people actually implement the strategy, you'll realize that perhaps 1, perhaps 2 out of 10 people actually do that, even though they know that buying low and selling high, at least in the long run, does make sense. So today we'll mostly focus on three out of 12, if I'm not mistaken, biases that are described by behavioral finance. So one of them is anchoring. So investors exhibit anchoring bias, tend to use an arbitrary benchmark, like a purchase price, to tie future decisions to this price. So in this case, individuals may hold on to investments that have lost value because they're anchored to their original value. So we thought about a good example just so no one gets offended in any way. And we thought that General Electric would be a good choice. I mean, everyone knows That's just to be a household name, a blue chip included in pretty much every single portfolio. So the top price in the year 2000 was close to $450. Recently, it traded at $64 a share. And I personally know quite a few people who are still holding on to it, hoping that at some point in the future, perhaps it will hit that 450 per share price. Now, perhaps that's going to happen, or perhaps that will never happen, because again, the markets are very dynamic, they're ever changing, and perhaps General Electric is competing in a very different environment versus 22 years ago. So how do you, if not eliminate, but at least reduce this bias? Well, keep journals that document why you bought a particular investment, in this case, General Electric stock, and what circumstances actually have changed since you made that decision. And again, as a little side note, there are a lot of stocks that went down 60, 70, 80, 90% over the past 2 years or so. So keep that in mind when you're making your decisions. Confirmation bias. So investors with confirmation bias tend to seek data that confirms their original beliefs, and they tend to ignore information that contradicts these beliefs. So in some sense, on the surface, there's nothing particularly wrong with that. Well, some people are more conservative, some people are more aggressive in terms of their investments. But perhaps a good example of that would be these so-called perma bulls and perma bears. And you see some of them on TV. I'm certainly not going to mention any names, and I have those names in my head. And essentially, they're promoting certain things. So as a result of that, they're permanently bullish. Doesn't really matter what's happening. Doesn't matter what's happening with interest rates or economy, global dynamics. They're always buying more. Then you have this perma bears. They're always in this bad mood. Very frequently, they're advertising different commodity investments, and their perspectives essentially never change, even though in reality, again, the markets are very dynamic and ever changing. Now, how to avoid or reduce this potential bias? We'll focus on long-term data. Again, we talked about commodities earlier today. They certainly performed well this year. Perhaps they'll continue to perform, perhaps even for the rest of the year. But what about their long-term performance results? Do you have that data that supports it? And of course, find someone to play devil's advocate. Someone who would present a different point of view and see, how you can communicate with that person. Finally, perhaps one of the most important, and we always consider this bias specifically when we design our financial plans and investment policies, is this loss aversion, which is the tendency to avoid losses rather than focus on achieving gains. And psychologically, and this is a very well documented fact, the pain from losses for most people is significantly worse than the pleasure gained from movements in the same direction. Now, on the surface, in some sense, I'm almost inclined to say this is a positive bias. And here's an example for you. Let's say we're working with a younger investor, has, let's say, a small portfolio, and let's just assume this investor goes all in and buys something very volatile, and it doubles in value. Well, that's great. We'll be happy. Let's say this person loses all of his or her money. Well, chances are not much is actually going to happen, because perhaps over the next 20 or 30 years, he or she would be able to save more. Now, it's very different when people are perhaps in their retirement years. They already saved enough to feel comfortable, let's say, in retirement. So for them, if their portfolio value goes from $1 million, to $2 million, perhaps there's not going to be much of an improvement in the actual quality of life. Now, if it goes from $1 million to $500,000 or below, well, there's certainly going to be quite a bit of an impact in the long run. So from that perspective, almost like a positive bias. Now, the issue here, and that's what you see on the bottom of the slide, is when people are extremely risk averse, so they're not able to take any calculated risks, which is what we're trying to accomplish. And of course, as a result of that, once, twice, 3 times in the long run, chances are it would severely impact their long-term performance results. Now, how to perhaps eliminate or at least reduce this bias, have a financial plan in place. That's perhaps the best option here. So to sum this up, in terms of some of our top ideas at this point, we actually always recommend that our clients rebalance their portfolios semi-annually or at least annually, depending on what's happening in the markets. Of course, it's been quite volatile, so now would be a good time in some sense, regardless of your investment strategy, plus harvesting losses for tax purposes. And Debbie will talk about that separately. There's this classic approach when you move your portfolio, let's say from bonds to stocks. At this point, it's probably not going to be from stocks to bonds. Also, again, from value to growth, depending on your perspectives. For those of our clients who have longer time horizon and or above average risk tolerance, perhaps this would be a good time to overweight their large cap, domestic large cap growth companies or that particular style. Now here I have to be careful just to make sure there are no misunderstandings. I'm not trying to imply that they'll recover soon or they're the best investments out there. It's just that if you look at it from the big picture perspective, and we discussed morning slide charts, that's where you see the biggest discount. Again, a lot of those companies, they have solid revenues, they have solid earnings, they're expected to grow. These are not your high flying stocks, that we had quite a few of them over the past couple of years. So, and when you overweight, we're looking 1 to maybe 3 percentage points. We're certainly not going to, Debbie likes to say, dump the apple cart and reinvest into large growth. Now, dividend-paying stocks or so-called dividend aristocrats. If your risk tolerance is not quite there, you're just not comfortable with the growth idea, there are many dividend-paying stocks, specifically those that have been making dividends for the past 25 years and also increasing them, that are selling at a discount. International equities, in terms of our managed portfolios, and I know we didn't spend much time on that, we currently underweight international, including emerging, in most of our, again, managed portfolios. Now, very briefly, many of the issues that we discussed today, they're either worse or significantly worse outside of the US. I'll just stop on that. Now, there's one interesting category. We started looking into this recently, specifically large cap international value stocks. They used to pay quite nicely, 3 to 4%. Now you're looking at 5 to 6. And then finally, in terms of your fixed income allocation, especially if you're bond heavy, meaning you have 40% or more in your portfolio, well, perhaps you'll see better yields. So consider that. And perhaps over the next 3, 6, I'm going to say maybe even 12 months, you'll have this ability to perhaps even start building bond ladders. And we're not going to go into that in much detail, but that's one of those classic protection strategies that we used to employ maybe 5, 6 years ago at this point. So with that, we'll pause and see if we have any questions.
And Alex, I'm going to launch the second poll right now too. So the second poll will also show up. Please check the chat box or your screen. I'll keep it up for about 30 seconds.
Sounds good. So what I will do then, I'll scan the chat box pretty fast. Just so you know, please ask your questions freely. What we're going to do, we're going to read them out loud, but we will not mention your name, just if you're concerned. So we'll read it out loud, but we'll not mention your name. Okay, so one of the questions is about our services. This is meant to be an educational webinar. This is not about selling our services. So if you're asking great questions, so please reach out to us separately and be happy to schedule a meeting with you to discuss that. I just don't want it to be like it's about our services. Okay. And it's recorded. Okay, so these are some of the questions that were submitted to us prior to this webinar. Okay, despite having a diversified investment allocation plan, are there tactical changes to be considered in this current economic climate to better protect those asset classes experiencing the biggest losses? And it says in parentheses here, for funds held for long-term horizon, 10 years or more. So, Debbie, you want to comment, or I'll let you?
You can go ahead. You can go ahead.
Yeah, so it's interesting how this question was phrased. Of course, perfectly understand this question, but for someone who has a 10 plus year horizon, chances are you should not necessarily be thinking about any potential protection mechanisms. Chances are you should be taking advantage of the market volatility at this point. At least that's how we refer to it. We talked about large cap growth stocks that are many are selling at a significant discount. If you're not comfortable with that, that's fine too. Perhaps consider going across the board, allocating to each asset class. And even if that's not comfortable, well, again, there are many value-oriented stocks, specifically dividend aristocrats, that have a history of not only making dividend payments but also increasing them.
Right. I'll just make one additional comment about that time horizon, is that we typically are asking people what their cash withdrawal needs are from their portfolio, inside of 7 years, which is a natural business cycle, but where they might have to take equities and to live on or to spend on something inside of 7 years. So 10 years is sort of outside that realm. And, that really helps us develop what we think needs to be in a very stable fixed income buffer situation, maybe preferred stocks, maybe a little bit more on the dividend paying types investments, rather than a more growth oriented idea if they need that money. So that's really mathematics and really very individualized, for that person.
Thank you, Debbie. And here's it's part actually of the same question, but the second part. What are your recommendations for investment options for short-term funds that will be needed within 1 to 2 years with no risk of principal loss, besides money market accounts or CDs? Well, in some sense, you answer your own question. If your time horizon is so short, 1 to 2 years, then money market accounts, high yield checking accounts, I guess more or less the same thing, or certificates of deposit are your best choices. See, with individual bonds, I'll just give you a little bit of a technical answer. You can certainly buy them today. Let's say it matures a year and a half from now. So you'll certainly get your money back, assuming it's a high quality corporate bond or perhaps some kind of government bond. But usually you wouldn't deal with individual bonds for such a short time horizon. There are fees involved. Perhaps you have to buy them at a premium. Usually with bonds or bond ladders, you'd want to construct them for, I'm going to say 3 to 7 years. Usually you wouldn't do it for 1 to 2.
Yeah, I would agree with that. I mean, I'm just going to say that our terminology for that would be reserves. So when you need reserves for contingencies, sleep well at night money, you're not going to go out on any kind of ladder when it comes to fixed income, or appropriated funds. Like we would typically ask people, are you planning on buying a new car? Are you looking for money for a down payment on a house in a year or two? And we're going to keep that very short term, no risk of principal in that situation.
That's exactly right. And here's one from the chat box. Although with inflation, you're essentially losing with money markets and bonds. Absolutely. So that's the problem when inflation is at 9.1, and that's, by the way, that's the CPI figure. In practice, it impacts people differently. In practice, it's probably somewhere between 6 to maybe 12%, depending on your spending habits. So yes, if you keep in something in an account that earns 1, 2, or maybe even 3%, in real terms, yes, you're losing money. One of the ideas we didn't want to discuss today, but in the long run, and I'll just make this comment, stocks are the best hedge against inflation. And again, there's a lot of statistics behind it, but in the long run, yes, you're assuming more short-term risk in the form of market volatility, but in terms of inflation risk or purchasing power risk, it's much, much lower with stocks.
Right, because I did want to mention that, since you were saying the sort of the positive side of the interest rates going up is there is more interest income on fixed income, but that was never designed to beat inflation. It's going up only because inflation is going up and the feds are raising the rates. It's good for your short-term reserves, to Alex's point. That's what you're going to be losing money in the long run. If you parked everything there, inflation is going to really eat through that.
That's a very good point. You have two more questions. They're essentially identical. You mentioned CDs averaging 2.6% for 6 months. I have not seen that. Can you point those out? Yes, the answer to this person, and the person is asking more or less the same question. Yes, please reach out to us separately and I'll point them out to you. I would rather not mention any specific names so that it doesn't sound like we're advertising for any institution, but yes, they're available. I will say they're available on our institutional platform. I would like to make an assumption that they're also available on the retail platform, if you log in on your brokerage's website, but I'm not 100% sure. But we already purchased some of them for our clients, so they absolutely exist. Again, please reach out after the webinar. Okay, so what do you think, Debbie? Should we take a few more questions or discuss financial planning first?
Maybe like if you think there's one more that makes sense that we didn't cover that's on the investment side.
Okay, so actually, well, there are some that are kind of like they're connected. They're both financial plan investments, so perhaps we should cover the financial planning piece and then get back to those questions. And maybe there'll be more from the chat box.
Okay, and I just want to say, if we're not able to answer your question here, you can certainly email us. We'll try to address your question. So I was going to talk a little bit about some subjects that I've talked about before, but in thinking about it, and Alex and I discussing, these are just incredibly timely for people. And I still find that people are not addressing them in a real-time environment. What I mean is that the markets are very volatile, and people traditionally wait towards the end of the year, and maybe they understand, wow, if I need to take some losses for tax purposes, let's do it then. You really need to do it in real time. I know that we've looked at our portfolios that we're managing 2, if not 3 times already this year because of the volatile markets. And that actually, I just want to say, also happens on the positive side too, like in 2021, which was a very big year for investment returns, and people needed to take some of those capital gains off the table, which is the selling high part of it, but taxes had to be paid. So that's never a pleasant experience, but you have to economically take those gains. Now you're in the same position, in a lost position. So you want to get the tax benefit from that. If you want to go to the next slide, Alex. And what we're trying to do is get a tax benefit, and that benefit from actually selling a lost position can be anywhere from 23% to 33%, because we're looking at federal rates and we're looking at state rates. Okay, and in some cases, net investment income tax, which can push you up to 1/3. So it's very beneficial. It is part of your returns when you think about recapturing some of the taxes you've already paid on investment income. Now you can do the reverse. You're going to reinvest that money right away. I mean, it's not an economic loss, which I think some people feel. You're going to put that money right back in to a very similar investment. Can't be exactly the same for 30 days, but there's so many mutual funds that are really doing the same exact strategy that we would have several to choose from to get that money right back in the market. So all you've done is captured a 23 to 33% tax benefit on taking the loss. And then, you can bank those losses. So if you ended up having more losses than capital gains, there's a limit to how much you can take in that particular year, which is $3,000. But that money, that loss will be protected, will stay there with your gains into the future. So we call that banking the losses. You've taken them in real time, and they can add up to a lot of dollars. So we basically say you need to be monitoring your accounts regularly. And I say at least monthly in that regard, to think about what is the potential for doing that. And we've been doing that in 2020, 2021, and now 2022 for obvious reasons. So that's the tax loss harvesting piece. Just again, a timely reminder to be looking at that. The next thing, Alex, was
Debbie,
going to talk about.
I'm going to launch the third poll here for attendees. Okay, we'll keep this up for about 30 seconds.
Okay, just did mine.
We are attending, right?
Yes, we
We're
are
present.
Here. So the withholdings and tax estimates, again, we've talked about this before. this is also a really good time to relook at this. A lot of people are paying taxes the same way they paid in 2021. 2021, we know, had a lot more investment income, capital gains than we're expecting this year. So if you're paying on that basis, and sometimes even paying more because of your income level to have what we call sometimes a safe harbor, maybe you're paying quarterly estimates, whatever it might be, you are, I'm going to say, almost definitely overpaying. So you might want to take a look at that because you're not going to be able to get that money back from the government until you file your return next year. So you're not earning any interest on it, and it's tied up with the, with the IRS, with the state, until you can actually file and you can actually request that refund. So it's a good time to be looking at it. I always do it. My theory is like by September 1, that's kind of like after the summer. I'm usually taking a look at my tax projection, checking my withholding. I think obviously withholding if you're still working, or withholding if you're taking any distributions from your retirement accounts, where you can do withholding, and adjusting for the rest of the year. So you can adjust that upward if you needed it. We're talking about probably it needs to go down, or you can do any kind of withholding you need to do from, let's say, a retirement distribution more heavily at the end of the year, and not have done it all during the year when you really don't even know exactly where you're at necessarily. And that way you can hold on to the money a little bit longer. So that's a tax strategy, really having to deal with the markets at the time being, but always something you want to be paying attention to. And the last thing, Alex, is really the Roth conversion. And what we're talking about here is taking an IRA that you've been contributing to, either with tax deduction or no tax deduction, and looking at the value of it now. Let's just talk about values. Maybe that value has dropped a lot because of the market, and so it would be less expensive to now convert it and pay some tax perhaps on that conversion to go into a Roth IRA. And as most of you probably know, that's the type of IRA that doesn't require you to take distributions mandatory at 72, and it doesn't have any tax. It's growing tax-free for the future. And if you're not even going to use that and potentially use it very late in life, or something that your heirs will inherit, then that money continues to grow tax-free longer. So it's really a privilege to be able to do a Roth. However, there's taxes to be paid in some cases, and that's very much part of the analysis as to whether it makes sense to pay taxes up front. For people that have been contributing on an after-tax basis, putting in tax non-deductible IRAs, we would call them, and I'm going to say we always recommend them where there is somebody still working and can contribute, because that money's growing tax deferred. You're not getting a tax break, but that money's growing tax deferred. Taxes are real, as we know, and that money could be converted into a Roth tax-free because you didn't take the tax deduction. So we sometimes do that on an annual basis for clients. Put it in a non-deductible IRA, flip it the next day into a Roth. That's really almost kind of a loophole, like being able to do something we call the backdoor Roth, which is a little bit more sophisticated, but it's basically if you're still working and have a 401k plan or 403b or part of a TSP, that we have the ability to move some of the tax consequence of the IRA into a qualified plan, convert, and have no tax. So this has been around for a while, and just reminding people to look at this every single year, really, if you're eligible for something like this, and also because of the valuations coming down. Some people just relook at how much the cost is for converting. So that's it. That's all I have, Alex, the things that I wanted to mention.
Thank you, Debbie. And usually anytime we talk about tax loss harvesting, at least recently, year 2020 really comes to mind. It's still fresh in pretty much everyone's mind. So for many of our clients, specifically, of course, taxable accounts that were heavily and still heavily invested in equities, we finished the year with significant harvested losses. In some cases, it was actually hundreds of thousands. But the actual economic gain or portfolio return was in the positive. And that's, of course, very opportunistic. It's hard to plan for that. But when you manage in your finances, or specifically your portfolio in real time, yes, you can certainly, again, accomplish that in times of market volatility.
Alex, I'm going to launch the last poll here for the session.
Perfect. And then we have essentially 5-6 minutes, so we'll take some questions.
I want to just say something about the kind of the market that we're in, the experiences that we've had the past couple of years. We've had a lot of debacles in the past. For a lot of us, we can go all the way back to the hyperinflation of the 80s, the tech bubble, the financial situation, the real estate bubble, so many things. And we're going to have them in the future. So understanding that even if you're like approaching retirement and say your early 60s or 65, we're trying to project to 95. So it's unlikely we're going to go through a 30-year period and not continue to have the ups and the downs of the markets. What really is interesting is we never know exactly what's going to cause the bear market or to cause the recession. I mean, COVID being our last situation, and then all the, the inflationary pressures that's come out of everything that's been going on. That's what we're dealing with right now, right? So it's going to happen again. And my point only being that you really need to Alex's point, be ready to take some gains off the table when the market's going up in real time and not be sort of mesmerized by just the numbers going up. That's when you have to capture it, and you have to rebalance going into the market when it's down. So you have this game plan. I mean, you really are setting up the game plan in advance and saying, this is how much I want to have in fixed income because it's my buffer. This is how much I want to have in large dividend paying companies and so forth. And we just keep rebalancing, you keep tweaking. It's almost like dollar cost averaging based on valuations of markets. And when you talk about being tactical, we set up a range. So we're not necessarily going to say we want to go 100% moving now or 0%. It's that somewhere in the middle, and the continual doing of that where we know long term you're going to see the success. And that's the goal. And it really is just the management of you doing that with your portfolio regularly that creates that success. That's all I'll say.
Making such a good point, Debbie, and that at least partially answers actually one of the questions that was asked. We had multiple questions that are very similar. I'll just read one of them. When can we expect the stock market to turn around? Right. So to add a little bit of statistics to what Debbie just said, every 6 years we're expecting to have a recession. That is just statistics right there. Some of them last 1 month, 1 quarter. They can take as long as 3 quarters. So 2 to 3 quarters on average. An average recovery takes 4.5 years. But again, they really, the range is actually quite wide. I mean, go back to 2020, and the recovery took 2.5 months. So they can be much shorter. And again, I'll just in some sense repeat it for many of our, younger retirees, late 60s, early 70s. So yeah, if we're projecting for the next 25, 30 years, they should expect to experience 4, 5, maybe even 6 recessions. So the idea of being prepared for that is extremely important. So, and here's one. I mean, but that's again, how to manage retirement in recession. In some sense, Debbie, you already addressed that question. I don't know if you have any specific comments, but that was one of the questions.
I guess just to add on to what we were talking about in terms of having a buffer and fixed income for cash withdrawals, if we were in a down market, we wouldn't just sell across the board, some equities and fixed, and we purposely have that fixed income so that you don't have to sell equities in a down market. You're going to use that fixed income until we get back to a stable environment before we're rebalancing. That's the whole purpose of it. So that's really how you would manage it. I would say you would also want to do at least a benchmark retirement projection we do for our clients once a year. So you're not going to go to sleep at the wheel, which is what I say to people. It's not like you're going to like, oh, the market's up or the market's down and not pay attention to what that does for a 20 or 30-year projection. You're going to relook at it. And so that kind of keeps you in control of the adjustments you make. Are you adjusting your spending? Are you using some of your buffer that we built into a contingency reserve? Are you using some of your fixed income to get through this market period? That's how you manage it.
So that's a good point. Well, I guess let's take 2 more. These are hopefully quick questions. And this one, again, I find this interesting. How to protect a portfolio of equities from inflation? Well, here's a short answer for you. You don't have to protect the portfolio of equities from inflation. Again, equities as a whole, they provide a good hedge against inflation in the long run. It's not like in any given year, inflation is at 9.1% and your stock portfolio is up by 9.1%. That's not how that works. But in intermediate / long run, yes, stocks, kept pace and actually outpace inflation. Now, if you again want to, I'll use the term that was used previously, want to be more tactical, and that is something what we discussed, I believe, in the middle of last year when this whole situation just started. We'll focus on companies that have a history of not only making dividend payments, but also have a history of increasing those dividends over time. Again, back to that dividend aristocrat example. So what's so specific about them, again, without mentioning any individual names, many, they have very strong market positions. So they have this, better ability to pass their increased costs to their end consumers. It's not necessarily, again, one for one, but in the long run, they're usually able to do that. So that's that. And then finally, this one other question just came in the last moment. Is it smart to park money in CDs, short-term bonds, keep it in liquid and ready for when the stock market is healthy again? So what do you think about this one, Debbie? What are your comments?
I think what you're describing is trying to time the market, and that's not going to be successful most of the time. Again, in being tactical, I think you're trying to take advantage of when the market's going down. You want to go in when the market's going down. You don't want to wait till it's going up and then just more expensive. So you want to make sure that CDs, those cash reserves, are enough for you personally to have, and not park more in there hoping that you're going to get a better return. That's how we would approach that. It's more of a asset allocation, cash need calculation than saying, oh, the market's down, let's jump in, the market's up, let's jump out. Very hard to time the market. Things happen in very real time, very quickly. The markets are very efficient. And so you're going to, it's going to be really hard to be ahead of that curve.
Absolutely. And again, I know I already made this example, but look at what happened in 2020. The markets were down by 31% in 17 calendar days. So that was what, 13 or 14 trading sessions. 2.5 months later, by the end of June, they pretty much fully recovered and continued over the next essentially 18 months. So things like that, again, happen very, very quickly. Well, so with that, I actually skipped one of the slides, but we do have quite a few other events, financial plan investment events this year. The next one is actually this Thursday. Cryptocurrency tax and accounting know-how for small businesses and individuals. Very, very interesting. I'm actually going to be listening to that one. And then later this year in September, we'll start our series when we talked about young professionals, mid-career, and then pre and post-retirement. Grow your net worth, and in this case, it's starting your career in the right financial foot. So keep that in mind. And in terms of our quarterly market updates, they're usually closer to the end of the first month of each quarter, and we'll of course let you know about that separately.
Yeah.
Well, again, if anyone has any other questions, feel free to reach out. And thank you again. Thank you for joining us today.
Great. Thank you. Stay well.
Bye-bye.